My colleague, I think Mr. Meehan, asked a while ago about the exposure of the United States and our financial institutions. According to CRS, in U.S. dollars in 2011, September 2011, our total exposure is $2.08 trillion. Can you quantify that? You said you didn't know what I was talking about.
I'm not clear whose exposure you're talking about, the banks or the U.S. economy. I'm not quite sure what it refers to.
Well, since you don't understand it, if I submit this to you, will you check it out and let me know? I mean,
oh, certainly.
Could you answer that for me? I'd really appreciate it. The second thing I'd like to ask is one more time. I'm not a banker. I'm not a financier or a financial expert. But I'd like to ask this question one more time, and that is, if there is a default in Europe by Greece, Italy, Spain, Portugal, some of these other countries, and the European Central Bank has to start printing more euros, which would cause an inflationary problem and devalue their currency, you said a while ago, well, we were not in any trouble because they would pay us back in dollars that are holding. But what if they can't? Now, they're going to have to pay for the dollars that they're going to repay us with currency that's been devalued substantially. How are we going to get our money, number one? And number two, would we refinance that debt?
Well, Congressman, first of all, the ECB has been very clear that they are not going to be financing sovereign debtors, and they have not. And their primary commitment is to the low inflation rate, the 2% inflation rate in the euro. So I don't see any necessity or even likelihood that the ECB would print inflationary amounts of money in order to address a sovereign default.
I know, but it seems like to me Europe is absolutely committed to keeping Greece in the European Union and make sure that nobody's leaving.
Well,
and if these expenses continue in Greece, and they have these civil disorders, and possibly in Italy and these other countries, the European Central Bank and Germany and other countries are going to have to pay the freight to keep these countries afloat. Now, if they do that, it seems to me that the European Central Bank, and I talked to some of the leaders over there, they said that they would, of course, do like we did with quantitative easing, and they would print whatever currency they needed. Now, if they did that, there would be an inflationary spike, it seems to me, at some point. And if we had to recover our debt, how would they repay us?
Well, first, the European Central Bank itself has capital. It has.
You mean they have U.S. dollars?
Well, I guess their capital is in euros. That's correct.
Okay. Well, how would they repay us then?
Well, I guess they get repaid from the banks they lend to in dollars. That would give them dollars to repay.
Well, many of those banks could go belly up as well. So they would, they're going to have trouble recovering that. So the inflationary problem is a real problem. So how would we get our money back?
Well, again, the European Central Bank is a highly solvent institution. It is committed to low inflation. It is in turn supported by a whole network of central banks of the 17 countries, which have their own.
I understand, but that's not really answering my question.
The kind of scenario you're envisioning where they couldn't pay us back would be absolutely apocalyptic. It would mean a collapse of major governments in Europe. It would mean a collapse
well, let me follow up with this question.
Yeah.
Let's say that Greece defaults and they leave.
It's already defaulted.
Well, no, I understand, but let's say they are forced to leave the European Union because they don't comply with the new demands. And we have a cascading effect into Italy and maybe Portugal and Spain and some of those other countries. Mm-hmm. In a worst-case scenario, the European Central Bank and the other countries say, okay, we're going to try to keep this from becoming a catastrophe, and they start printing euros. We're obligated, and we're involved to a large degree, according to the figures I have. How would we fare in the United States, and how would we get repaid, and what kind of impact would that have on our country? And I know you used the term apocalyptic. I'd like for you just to explain a little bit more thoroughly.
Well, again, the money we've lent, or first of all, we have the swap that we've made, the collateral, we've taken collateral for it, which is coming down, is backed, first of all, by the European Central Bank, which in turn has behind it 17 national central banks which have gold They have other kinds of assets. Those central banks, in turn, are backed by the governments of the Eurozone. So it's an extraordinarily unlikely situation that we would lose any money. Again, it's a 3-month obligation. So it just, you're talking about a situation where national governments are defaulting across the Eurozone.
Well, if I might follow up,
30 seconds for a brief follow-up.
30 seconds. I know some of those governments over there are having political problems, and they're not anxious to pour more of their money and their resources into saving other countries. Germany in particular has had some political problems, and it may be more severe. So when you say these 17 other central banks are going to come across and help keep everything afloat, there's a political problem that's involved in that too. So that's why I ask about a worst-case scenario.
I didn't say
I think it's important that we understand all the problems that we might be facing.
I didn't say they were going to support the individual countries. I said that they would pay the United States back the swap money.